Welcome to the Deep Dive. Today, we are taking a really hard look at the Q3 2025 earnings call for Ashford Hospitality Trust,
Right.
ticker AHT.
Right.
And for anyone who follows the REIT space, this is a pretty unique situation. We're not just reviewing quarterly numbers here.
No, not at all.
This is a deep dive into really a high beta, high leverage turnaround story.
Yeah.
You've got management trying to execute a survival playbook against some really formidable financial headwinds.
That's the perfect way to frame it. And as talk tickers, our job is really to cut through all the management talk, the accounting noise, and find the real signals. Because with a company this levered, you always get this dual narrative. You have these operational successes on one hand, and they're battling these chronic financial risks on the other. So our mission is to figure out where are they actually succeeding and where are they just, buying time.
Okay, so let's unpack that, starting with the headline figures, because the statutory results were severe. If you only looked at the accounting, Q3 2025 was a brutal quarter for common stockholders. The GAAP net loss was a heavy $69 million.
Yeah, that's a negative $11.35 per share. A huge number.
And that pain carried right over to the key metric for lodging, right? Yeah. Funds from operations.
Absolutely. Adjusted funds from operations, or AFF, which is, basically their cash flow, was a huge miss, a loss of $2.85 per share. The consensus was looking for a loss of about $1.14.
Wow.
And even revenue came in light. $266.1 million, missed by about 2.8%.
So based on all that, it just sounds like a catastrophe of a quarter.
Right.
And this is the massive surprise. This is the signal the market grabbed onto.
Right.
Despite all that softness, despite those huge statutory losses, comparable total hotel EBITDA, it actually grew by 2% year over year.
And this is what's so fascinating. The implication of that one number, the stock, AHT, it jumped almost 5% on the day of the call.
So what does that tell you?
It tells you investors looked straight past the GAAP losses. They know that loss is driven almost entirely by the interest expense from their debt. They only care about one thing, cash flow generation, EBITDA.
Okay.
That 2% growth shows management is improving the core business. And in a high leverage situation like this, well, that operational discipline is really the only way to survive.
Let's get into that operational playbook then.
Yeah.
The driving force seems to be this initiative they launched late last year, GRO AHT. What exactly is GRO?
So GRO stands for Generating Revenue Opportunities and Optimizing Operations. It's a pretty deep, multifaceted cost control program.
So not just cutting staff.
No, they're much more focused on optimizing inputs, and you can already see the results. For example, their labor efficiency, it improved by 2.6% on a per occupied room basis.
That's great, but margin expansion is the real proof, right?
Precisely, and they got it. Hotel EBITDA margin expanded by 46 basis points. That's how they squeezed out that 2% EBITDA growth, even when their revenue per available room, RevPAR, actually declined by 1.5%.
So they're mitigating that revenue weakness with just really sharp cost controls.
Exactly.
But that RevPAR decline, that needs some context, because I saw it wasn't really spread evenly across the board.
It wasn't at all. You have to look at the Washington D.C. market. It's about 14% of their total room count, and it was a huge drag. Management said government room nights in D.C. were down a steep 18.8%.
18.8%.
Yeah. I mean, think about what that is. That's government travel budgets being frozen, federal agencies just pulling back. It's a massive headwind they have absolutely no control over.
So if we just, pull out that D.C. anomaly, what does the rest of the portfolio look like?
If you exclude D.C., their comparable hotel RevPAR was only down 0.3%. I mean, basically flat. So the vast majority of their assets actually outperformed the broader U.S. upper upscale segment. That's a sign of real operational resilience.
And then you have these proof points that the renovation spending is actually working.
Oh, exactly. You saw these massive returns on newly renovated hotels. The Embassy Suites in Dallas Galleria, for example, it delivered, get this, a 638.7% increase in hotel EBITDA.
Wow.
Right. And that followed a guest room renovation late last year. These kinds of wins are crucial. They prove the underlying value is still there if they can just fund the CapEx.
So the engine is running better than you'd think. But the debt is this massive weight holding the whole thing back. Let's get to the elephant in the room that's driving all those negative GAAP numbers, the capital structure.
And this is the terrifying part of the story. AHT is sitting on $2.6 billion in total loans. The blended average interest rate is 8.0%.
Okay, but here's the kicker.
Here's the kicker. The stat that defines their entire risk profile is that approximately 95% of that debt is floating rate.
95%. So every single move the Federal Reserve makes goes straight to their bottom line.
Instantly.
So with that kind of exposure, what are they doing about it? Are their liquidity measures actually enough?
Well, management's being aggressive. They're using asset sales to deleverage, which shows they know the clock is ticking. They sold 3 properties for about $75 million.
Right, and they call them attractive sales. Can you quantify that? What does an attractive 5.3% cap rate really mean for a REIT that's under this much pressure?
That's a great question. So a 5.3% cap rate on trailing 12-month NOI, basically, it means they got a really high price for the income those properties were generating.
Okay.
For a company in their situation, getting a cap rate that low is a huge win. It suggests their assets are still valued highly in the open market. It means this isn't a fire sale.
So not a desperate move. A strategic one that paid down debt and saved them, what, about $6 million in future capital spending?
It's intelligent triage. They're raising cash, cutting future expenses, and paying down debt all at once.
Yeah.
They also bought themselves some breathing room by extending that huge 18-hotel Highland mortgage out to early 2026.
Avoiding an immediate crisis.
Exactly. And they refinanced the Renaissance Nashville, which should save them another $2 to $3 million a year in interest. So they ended the quarter with decent liquidity, about $82 million in cash, plus another $167 million in restricted cash.
Okay, so let's look forward. Management didn't give formal Q4 guidance, but they're clearly all in on that GRO AHT program. But the real catalyst, it seems, isn't internal. It's macroeconomic. It's tied to those floating interest rates.
Absolutely. With 95% floating debt, AHT is exquisitely sensitive to rate changes. I mean, it is the perfect beneficiary of any future rate cuts.
They spelled out the math.
They did, very clearly. Each 25 basis point cut, so 0.25%, saves the company over $1 million a year in interest expense.
So help us translate that. What does it actually mean for the stock?
Well, think about it this way. Because of all that leverage, AHT stock acts like a volatility multiplier. If the Fed delivers, say, a 100 basis point cut, which isn't huge in the grand scheme of things, that's $4 million in annual savings that flows straight to the bottom line. It turns those massive interest expenses into manageable costs. So a small change in rates could lead to an asymmetric repricing of their stock from what is now a survival valuation to a recovery valuation.
And in terms of how they're using their cash, it's survival over shareholder returns for now.
Absolutely the right call. They confirmed no common dividend in 2025. All cash is going to deleveraging. They are still paying the preferred dividends, which is key for those holders. But the common stock is, it's a pure high beta turnaround bet.
Which is why it's underperformed the broader REIT sector so much.
Yeah.
But looking even further out, past the Fed cycle, they have this massive internal catalyst coming in 2026.
They do. The 2026 FIFA World Cup. About 42% of their entire portfolio's room count is in host city markets.
Dallas, Houston, Miami.
Yep. They are perfectly positioned for a huge concentrated surge in demand that year. It should mean outsized performance for almost half their portfolio.
Okay, and this is where it gets really interesting. We are now heading into our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on everything we've just covered.
Right. So fundamentally, AHT is a highly levered call option. It's a bet on 2 things: interest rates normalizing and their internal execution continuing.
So if you believe they can survive the next 12 months,
then the sheer amount of floating debt flips from being a liability to being a massive tailwind if rates fall.
So what's the pitch? What's the trade that captures that asymmetry?
The idea would be to look at purchasing deeply out of the money, or OTM call options with a 2026 expiration date.
Okay, so for listeners, an OTM call option is basically cheap lottery ticket.
It is. It gives you cheap exposure with a huge potential payoff if you're right, but your downside is just the small premium you paid if you're wrong.
And the rationale here is totally dependent on those 2 big catalysts aligning: rate cuts and the World Cup demand.
Exactly. I mean, if the Fed delivers 100, 150 basis points of cuts over the next year, the equity value could explode. If GRO AHT keeps working and the refinancing holds, that cumulative savings could cause a total repricing of the stock. It's a pure play bet that management can win the race against their debt maturities.
It's risky, it's heavily levered, and it's totally dependent on the Fed and their own discipline. A classic high-stakes turnaround trade.
That's the one.
So, to summarize the core takeaway from this deep dive, AHT is executing its operational playbook. GRO AHT is generating real, visible EBITDA growth at the property level.
Right. And that positive momentum is the only thing keeping the stock in the game right now.
But it's still just completely overshadowed by that massive GAAP loss and the systemic risk of having 95% of your debt floating.
And that's the defining element here. The whole thing is a race against time. The question you have to ask is, can management successfully refinance the rest of their major debt before that tailwind of rate cuts actually materializes?
So it's a race between debt maturity and Fed action.
It is. The success of this turnaround hinges entirely on who reaches the finish line first. That is the ultimate trade-off you are making with this stock.